should definitely space them out. Now, how far apart is definitely relative. If you're going to go get a car and you're going to get a credit card, not necessarily a big deal. You don't necessarily need to space those out 3-4 months or anything of that nature. But in your example, you talked about a home purchase. Now, a home purchase is the biggest investment and it's the most intricate when it comes to and most stringent criteria to qualify. So when you plan on buying a home, you should definitely hold off on creating new accounts. And I don't care what that account is. You shouldn't go get a credit card. You shouldn't go get a Speedway gas station card. You shouldn't get, if any of you guys are old enough to remember Fingerhut, you shouldn't get a Fingerhut account when you're looking at trying to apply for a mortgage. And definitely shouldn't go buy a car. Because what'll happen then is, what if your credit score is great, but then now you have a debt problem because, you went and bought a $400 or $500 car or something like that. So you should definitely hold off on creating new accounts for at least 9 months before you buy a home. And especially if your credit is challenged. If you have credit challenges, you do not need to go and get more debt. Debt specifically, your debt to income ratio is the main factor is one of the main factors in being approved for your mortgage. So of course you have what your credit score is, but then also they're looking at your debt to income ratio. And the debt to income ratio is not to be confused with your debt utilization when it comes to your credit cards, but your debt to income ratio. So how much money do you make and then how much is going out? And then they do a percentage. And they have their own criteria. So if you hit that percentage or you're lower than that percentage, then you're fine. No problem at all. Your debt's good. That's not a barrier for you. If that is an issue for you, then that's when they start to scramble and see if you have additional money or things of that nature. And fortunately for all of us, when it comes to a mortgage and applying for a mortgage, fortunately or unfortunately, it's always a double-edged sword when it comes to things, that they look at your gross. They're looking at your gross, what you gross, not what you bring home. So what you gross. So before FICA gets a hold of it and, you pay your Medicare and you pay your insurance, all the things that comes out of your check before you get your check, they're not looking at that bottom number. They're looking at what you gross. So if you make $50,000 a year and you divide that by 12, whatever that number is, that's the number they're looking at. So they're not looking at anything else after that. And then they start taking away whatever on your credit bureau that you have to pay. So if you have a car note, a student loan, if you currently have a home, those kinds of things. Now, what's not on your credit report is like if you rent. So that's not on there, but they're going to take that into account as well when they start looking at your debt to income ratio. What they don't take into account is what you pay for like utilities. If it's not on your credit report and you have child support, they don't necessarily take that into account. Now, on that form, on the application, it's definitely going to ask you about your child support. And it's up to you if you're going to put down, I pay child support or not. That's between you and your God. I'm gonna stay out of that. But those are things that they look at when you apply for a mortgage. So those are some of the things that you definitely need to be aware of. And it is a double-edged sword because some people get into trouble. They just simply get into trouble because they have other bills that are not being calculated. Everybody's got a cell phone. People have cable and internet and all those things. And none of those things are factored in your debt to income ratio. And they're taking it off of money because they're taking your gross that's not actually coming and being in your pocket. So that's some of the things that you need to be aware of when it comes to a mortgage. So let's say, back to you, Brandon. So let's say if you have a new car payment and that new car payment is $400 or $500, then potentially it could throw you out of whack. It could throw your debt to income out of whack, and that's creating an issue for you. So definitely hold off. If you're talking about getting a mortgage or buying a new home, you definitely need to go ahead and hold off on that. And let me warn you, now once you've put in that application for a mortgage, do not, I don't care when it was you put that application in, do not do anything at all to your credit. Don't get a new card. Again, no inquiries at all. Don't have anybody pull a credit bureau on you or anything. And don't be late on anything at all. Do not be late on any of your credit cards or anything that reports to the credit bureau. And when I say no inquiries, I really mean no inquiries. I spoke to you guys before on previous show about how how the phone companies are having hard inquiries. So if you go to switch from AT&T to Sprint, or from Sprint to T-Mobile or whoever, then you're getting an inquiry on your credit report, and that's going to bring down your credit score. Now, it may just be a couple of points, but every once in a while, a couple of points makes the biggest difference altogether. So you need to make sure that you govern yourselves accordingly when it comes to applying for a mortgage, and if you should space those things out and things of that nature. Like I mentioned earlier, if it's a credit card you want and you're going to get a car, it's probably not a big deal. Car companies, the banks that deal with the car companies are not really focused on those kinds of things, because the credit card, if you go apply for a credit card and you don't go charge it right away, and you don't get a $20,000 limit or something, then they're not necessarily concerned about those things when it comes to granting you a loan for that. So, Brandon, I know it was long. We talked about it before. So I hope this helps you in your quest. And yes, I want to say yes and no again to your question. Should you space it out? Depends on the purchase. So thanks a lot. I appreciate you listening to the show. And I'm sure we will hear from Brandon yet again in the very near future. So before I get back to the topic for today, which is your spouse dragging down your credit score, I want to give a couple of shout outs. I want to give a shout out to Shauna. She goes to Living Purpose Church, which is my church, you guys, in Aurora, Illinois. I want to give her a shout out. I want to give a shout out to my old college roommate DJ. I saw him at homecoming this past weekend. I want to give him a shout out. I also got to shout out Rick. Can't help but shout out Rick as well. And then I want to shout out Matt Brontex, a good friend of mine as well from Indiana University. So I want to give those shout outs today. And let's move in back to the subject of today. Is my spouse dragging down my credit score? And again, in a word, no. But here's how it does. Now, Brandon just asked us about a mortgage and etc. So when you apply jointly, oftentimes the lender, especially with the mortgage, but with autos as well, they take the lower score of the two applicants. And this is really the meat of what I want you guys to hear today. They take the lower score. So this is how it affects you. So no, your spouse's credit is not necessarily on your credit report, but when you go to apply jointly, here's what happens. Now they're going to take, say you go get a car, they're going to take the lower score of the two applicants. So like I mentioned earlier, if you have a 725 and your spouse has a 625, they may base their rate off of the 625. And so that's when it really affects you. Now it's backwards from the consumer standpoint, of course, but from the bank standpoint, they win when it comes to that. Now let's look at if you go to buy a mortgage. And here's something that I call the combo. So this is what they do when it comes to that, and you go apply for a mortgage. First, when you go apply for a mortgage, unlike when you go apply for a car or a credit card where they just pull one of the credit bureaus, you go apply for a mortgage, they're going to pull TransUnion, Equifax, and Experian. All three of those credit bureaus. They're going to pull them all. They're going to look at your score. And oftentimes what they'll do the median. So the score that's in between. So if you have a 700, a 712, and a 722, they're going to base your rate off the 712. That's what they do. If it's just a single person, one person doing that, that's what they do. But then if it's two people applying, they're going to pull three credit bureaus from each person. And then oftentimes what they'll do, they'll combine those and they'll do the average. So let's say you have a 750 and then your spouse has a 550. So 750 and a 550, that's 200 points difference. So your average is 650. Now I just told you guys that you need about a 640, maybe a 650 to even qualify for a loan when it comes to your credit score. So now you're at a 650. So you don't get the best rate. You don't get the rate that the person that has the 750 and a really good score and an excellent credit would get. You're going to get the score of a person with 650. So that's something that how it really, really affects you. So all of you people that are engaged, newly married, you're looking for a home, things of that nature, you need to make sure that you both are on par when it comes to increasing your credit scores. That's what you definitely need to do. So barely, that 650 barely qualifies you for a mortgage. So, and I think last week at the beginning of the show, I kind of talked about what your rate would be, at least in current times, and how much more money you would pay if you had to get a rate off of a 650, or if you had to get a rate off of a person that had a 700 or a 750 credit score. So go back again and listen to I think it was the 7 ways to reestablish credit. At the very beginning of that show, I talked about the mortgage. So that's how it affects you. No, your spouse's credit is not on your credit. But when you start combining things, when you buy a car together, when you buy a home together, if you happen to go and fill out the application when you go to the furniture store to furnish your new home, that's when your accounts start to combine together. Now, if you are the person with the good credit, you're the person with the good credit, here's what you can do to help your spouse and help them boost their score. I talked before about helping them by becoming an authorized signer. Take one of your credit cards and have your spouse become an authorized signer. It's got to be a good credit card, one that you've had no issues with at all, and that card will actually help your spouse's credit to increase. That's one of the things you can do. And the second thing you can do is you can be the co-applicant on a loan or with the credit card. If you guys go in and apply together as a co-applicant, both of you guys get a credit card and you have a good score. Maybe they'll base the interest rate off of the lower person, but you guys have started to establish a new and good credit account. And that'll help your spouse as well increase their credit scores. Now, you may need some professional help, and I'm always here. If you need professional help, contact me at 800-creditscoreman@gmail.com if you need some professional help. Because the tips that I give out on a weekly basis and the people I talk to all throughout the week, they are definitely tips, but there are other strategies to help you increase your credit scores. So that's the show for today, you guys. Thank you very much for listening. Don't go away just yet. I told you I got a special offer for you. And then I want to give you the credit score kiss. Now, with the special offer, I know if I ask you guys to do too many things, you're going to wind up not doing any of them. So I'm not going to do so much for you guys today. With the credit score kiss I mentioned earlier, I want you to go to my website and read my blog. Read about today's subject on my website, which is www.creditscoreman.com. Again, www.creditscoreman.com. That is your credit score kiss for today. Now, in regards to this special offer, before we get out of here, the special offer is this. You're going to need my email address, and I'm going to give it to you first, and I'll give it to you at the end. It's 800-creditscoreman@gmail.com. 800-creditscoreman@gmail.com. All good things come in threes. So the first three people that email me at 800-creditscoreman@gmail.com, I will give a free credit consultation. So the first three people that email me, 800-creditscoreman@gmail.com, I will give you a free credit consultation. So get to your email and email me, and I'll give you that free credit consultation. Again, thank you guys for coming in and tuning into the 800 Credit Score Man show. You know I really appreciate it. I need you to share this. I'm asking you to do something else. I need you to share this broadcast, however you're listening to it. Hit your share button and share it with your friends and family. I would really appreciate it, and I think that they would actually appreciate it as well. So before I get out of here, I gotta say it. Cameron, Kobe, Cameron, Carter, all 4 of y'all, Kobe, Cameron, and Carter, I love you, and there's nothing you can do about it. I'm out.